Welcome back, everyone. Let me start with a simple question. Why is that when stock becomes expensive, everybody wants to buy them? But when good companies become cheaper, suddenly nobody wants to touch them. In real life, if your favorite brand goes on a discount, you feel happy. But in the stock market, when prices fall, people feel scared. And that is the strange psychology of markets. There's a very famous idea often repeated by legendary Warren Buffett. The stock market transfers money from impatient to patient. And if you look at history, some of the best opportunities have appeared exactly when sentiments were weak, headlines were negative, and investors were unsure about what comes next. So, today, instead of chasing the momentum, we are going to do something different. We will look at three different companies that are not unknown, not speculative, but established businesses, companies with strong brands, consistent demand, and long operating history, where the stock price has corrected, but the underlying business largely remains intact. The goal of this video is not to predict the market, but to understand whether the price decline reflects a real business problem or simply changing market expectations. Now, before we begin, a quick disclaimer. I am not a financial advisor, neither I am qualified to give any stock tips. This video is purely for educational purpose. Please do your own research before making any investment decisions. Nothing discussed here should be considered a recommendation to buy or sell any stock. Alright, with that out of the way, let's start with the first company. Now let's talk about a company that probably begin your day to day. Yes, I'm talking about Colgate Palmolive. Now this is not the kind of company that makes headlines every week. No AI announcements, no dramatic product launches, no CEO tweeting something that moves the stock 10%. This is a very boring business, and boring is what makes you money. Because no matter what is happening in the world, be it recession, inflation, elections, or even when people say, I'm cutting down my expenses this month, nobody wakes up and says, you know what, I'll stop brushing my teeth to save some money. That's the kind of business Colgate operates in, which is why it becomes interesting when you see the stock price. So, from its recent high around September 24, the stock is down more than 45%. And for a company like this, that's not a small correction. That's the kind of fall you normally associate with the companies where something has gone seriously wrong. But when you actually look at the business, nothing dramatic has happened. Let's talk about the valuation first. So the company's valuation is around 43, which sounds expensive if you compare it with the cyclical companies. But for Colgate, this is actually close to normal. If I go down and show you the normal average median 5 years PE is around 44, and if we see the 10-year PE, it is around 45. So the stock hasn't suddenly become cheap, it has just come back to reality after being priced for perfection. And market had hate perfection when growth slows even slightly. Now look at the business quality. If I go up and if you see the ROC is 105% and return on equity is 81%. These are not normal numbers. These are the result of strong brand recall, pricing power, and a business that does not need massive capital to grow. Now, if we look at the quarterly results, you can see the quarterly numbers also look stable. Sales are near historic highs at about 1486 crores, and profit remains strong at around 324 crores. So operationally the company is doing what it has always done, steady execution. If we look at the balance sheet, borrowings are almost negligible at around 60 crores, but and if you see the cash equivalent, so the company has a cash of around 1347 crores. In simple terms, this is a company that can sleep peacefully at night because of no debt stress, no survival risk. Now, if we look at the shareholding pattern, it again tells a very calm story. Promoters haven't reduced their stake. It remains same as 51%. Although there is a slight reduction in the stake of FIIs, but domestic institutions have stepped in and absorbed that supply. So the business looks stable, financials look strong, balance sheet looks clean, but the stock price is still down sharply. And sometimes the market behaves like that one friend who suddenly stops replying. Not because something is wrong, but because expectations have changed. Maybe growth slowed a bit, maybe investors moved toward faster growing sectors. Maybe FMCG supply went out of fashion for a while. The key question now becomes, has the market already priced in all the negatives? Because when strong businesses correct without fundamental damage, that is usually where long term investors start paying attention. Now, let's move on to the second company on the list, a company that honestly needs no introduction in India. Yes, I am talking about Tata Consultancy Services or TCS. This is India's largest IT services company, one of the biggest exporters of technology services globally, and for years it has been considered a core long term holding for many investors. But despite all of that, the stock has corrected sharply. From its recent highs around September, the stock is down roughly 41%. And if the stock will go back to those previous highs, it implies a potential upside of close to 69% from current levels. So the obvious question is, what went wrong? Because this is not a company facing debt issues. This is not a company losing market share. And this is definitely not a company struggling to survive. The biggest overhang right now is AI. There is a growing narrative in the market that artificial intelligence will disrupt traditional IT services. The argument is simple: if AI can write code faster, automate testing, and reduce manual work, then clients may need fewer engineers, fewer billing hours, and eventually fewer outsourcing contracts. And markets, as always, move ahead of reality. Even every time AI makes progress, whether it's new models, automation tools, or productivity gains, investors start questioning whether IT companies will grow slower in the future. So, sentiment has turned cautious across the entire IT sector, and TCS hasn't been spared. Now, here's where things get interesting. When fear increases, valuation usually comes down faster than fundamentals. Currently, if we look at TCS fundamentals, so TCS is trading at a PE of around 19, while if we look at its 5-year median PE, it is around 30.6, and the 10-year average PE is close to 26. So from a valuation perspective, the stock is trading significantly below its historical averages. Now let's talk about its business quality. The ROCE for a company is 64.6% and ROE is 52.4%, which again shows strong capital efficiency. These are numbers you typically see in companies with strong client relationships and long term contracts. Market capitalization stands at 9.7 lakh crore, making it one of the largest companies in India, and scale itself become a competitive advantage in global IT services. Now let's go to the quarterly results, and you will see that the revenue has touched around 67,000 crore rupees, which is the highest so far. Net profit came in at about 10,720 crores, slightly lower than if we compare it with the previous quarters. But this is where the headlines can be misleading. The dip in net profit was largely due to this exceptional item. So if you go under other income and see exceptional items, roughly 3391 crores rupees, which impacted the final reported numbers. So if you actually look at operating performance, here operating income has increased from 17,000 crores to 18,000 crore. So operationally, the business is still growing. The pressure is more optical than structural. Looking at the yearly performance, revenue has reached around 2.6 lakh crores, again the highest in the company's history, and profit remained close to peak levels. If we look at the balance sheet continues to remain strong. Borrowings are around 10,000 crores, but the company hold approximately, if you see, approximately 14,000 crores in cash, meaning it is comfortably positioned with no financial stress. And the shareholding pattern also reflects stability. If you see, promoters hold around 71%, FIIs around 10%, DIs have increased their stake and they now hold about 13%. And public holding is only about 5%. In simple terms, nearly 95% of the company is held by long term or institutional investors, which usually reduces volatility over the long run. So the situation with TCS right now is quite interesting. The business looks stable, the financials remain strong, but the market is trying to price in an uncertain future because of this AI disruption. And sometimes the market overestimates short term disruption while underestimating long term adaptation, because historically IT companies have always evolved with technology shift. The real question is not whether AI will change IT services, it definitely will. The real question is whether companies like TCS will adapt AI or will they lose because of this AI. Uh, and that debate is exactly why the stock has corrected. Now let's talk about the most controversial one on this list. A company that does not have decades of track record. A company that is newly listed. A company where you are not really buying the past, but you're buying the future. Yes, I am talking about Geo Financial Services Limited. This company was listed in 2023, and since listing, the stock has mostly moved in a range. It touched a high of around 394, 395 in April 2024, and from there it is down roughly by 33%. Now, here is where it gets interesting. Unlike Colgate or TCS, we do not have a 10-20 years of clean financial history to analyze. This is not a proven cash machine yet. So, what are investors betting on? Yes, you guessed it right. It is management. Geofinance is a part of Reliance Industries, and whether you like Reliance or not, you cannot ignore one thing. When Reliance enters a sector, it does not enter quietly. Remember telecom? When Geo entered, pricing changed. The entire industry structure changed. Smaller players disappeared, and today the telecom market is largely dominated by Geo and Airtel. That is the kind of aggression and scale Reliance brings into a sector. So when Reliance says it wants to build a financial services ecosystem, lending, insurance, asset management, payments, the market pays attention. Now let's talk numbers honestly. So if I go to Geo Financial Services, market cap is around 1.6 lakh crores. The stock P looks very high, around 106, but that is because current earnings are still small. The market is not valuing it on today's profit. It is valuing it on what it could become in next 5-10 years from now. That's why this stock is more about vision than valuation right now. ROC is again low, around 1 to 2%, which again shows the business is still in early stages. This is not yet a mature, high efficiency financial institution. Now, if we look at its quarterly results, revenue recently came in at around 901 crore, almost double compared to the previous quarter, 438 crore. That shows scaling is happening. Now, net profit, if you see, has slightly dipped from 295 crores to 269 crores, but fluctuation at this stage are not unusual for a growing financial company. On a yearly basis, growth has been sharp. From very small numbers initially, revenue has grown meaningfully over the last couple of financial years. Profits have also increased significantly compared to the early base. If we go down and see the balance sheet shows borrowing of around 10,000 crore rupees, while cash stands at 810 crores. For a financial services businesses, leverage is part of the model. What matters more is how efficiently they deploy capital going forward. If we see the capital promoter holding, it stands at around 47%, FI is around 11 to 12%, DII is around 15%, and public holds around 25 to 26%. So ownership is relatively diversified, but institutions are already involved. Now, here's the real debate with Geo Financial. This is not a stock you buy because it looks statistically cheap today. This is a stock people buy because they believe in the execution capability of the Reliance ecosystem. If they successfully build a digital first lending and financial platform integrated with Geo, retail, and digital users, the optionality is massive. But if execution slows down, valuation compression can happen quickly because expectations are always high. This is what I call a belief stock. You are not investing in what it is today, you are investing in what it could become. And that makes it both exciting and risky. So today we discuss three very different type of opportunities. The first one, a boring but powerful FMCG leader. Second, a global IT giant facing AI fears. And third, a young financial company backed by one of India's strongest business groups. Three different risk profiles, three different growth narratives, three different reasons why the market has corrected them. Now, the big question is which one fits your investing style? And more importantly, which one has the best risk reward from here? That is something every investor has to decide based on their own conviction and time horizon.